Hey everyone, welcome to our noon session, Legalese for the Manufacturing Startups. This is our materials and manufacturing track. And with us today, we have David Wilbrand, the chair of the Early Stage and Emerging Company Practice Group at Thompson Hine. He's practiced in this space for 20 years, along the way has launched 2 venture-backed startups. He also teaches startup and venture capital law at Syracuse and Cincinnati, and teaches M&A at the University of Michigan Law. David, I'll pass it over to you.
Great. Thanks, John. Thanks, Jen. Great to be here with all of you. I can't see you, unfortunately, but we will make do virtually. As John mentioned, the legal practice that I'm engaged in on a day-to-day basis is the representation of tech and biotech startup companies and entrepreneurs and founders. And I also work with investors, venture capital funds, institutional investors, angels, high net worth individuals who invest in companies like that. I've been doing it for 25 years, and some of that we touch on over the course of today's presentation. I do some literal teaching, as John mentioned, at a handful of different law schools, but in the course of my walks and journeys across the earth, much of what I do ties back to the session we're going to have today. For founders and first-time founders in particular, the notion of these legal concepts can be a bit of a black box. Most founders come to startups as world-class experts in something, which is why they feel catalyzed to start this company. So they might have a particular insight when it comes to intellectual property or technology or product development or marketing or what have you. But for most, very, very few have had any real interaction with lawyers in general or with legal concepts in particular. And it doesn't help that there's a lot of information, but a lot of bad information and a lot of confusing information available on the internet. So it's not uncommon for me in my day-to-day practice to have these interactions with actual clients where we're talking through these concepts and trying to get a handle on what they mean and what the import is to them as individuals and as founders of these startup companies. And so what I'm going to try to do today is unpack a lot of those concepts, which tend to be pretty general, pretty transcendent, show up deal to deal, company to company. If you are in the tech or biotech startup world, you probably will recognize some of this, if not all of this. So that's great. If you already have some exposure, a little bit of exposure is never a bad thing. It will help you, I think, get rooted and grounded in this, but it's also set up and teed up for the first timer. So if you've never heard any of this, that's quite all right. It should be accessible. That's my goal. And so let's jump in. We don't have a ton of time. So we're going to run until 1 o'clock Eastern. It's 12:05 now, so 54 minutes. And we will do the best we can. So what I'm going to do is I am going to share my screen. Let me go to that. I'm going to pull up a whiteboard. And if someone can confirm for me that they can see this.
It looks good.
Perfect. Okay. So let's jump in. And first things first, let me give you my email address. It's lengthy, but you might want to take the screenshot once I get it all written here. This will take 50 minutes of our 55. I'm a lawyer at a law firm. Branding is not something we do well. David Wilbrand, or David.Wilbrand at thompsonhine.com. I'd be happy to. We don't really have time, or within this format, it doesn't work particularly well to take questions within the context of this session, but I would be happy to respond to any questions or follow-up comments or reflections that you may have. So don't hesitate to fire them off to me at david.wilbrand at thompsonhine.com. I'd be happy to respond. So one of the things that I like to do when I do this session is to start with a balance sheet. And a balance sheet has assets on the left and liabilities over equity on the right. The notion is that it balances. The assets equal liabilities plus equity. Okay, this is an accounting concept, but we start a legal session on these accounting concepts, because these accounting concepts are so core and so fundamental that they drive everything else that we speak to from here. So let's talk about why that is. I mentioned at the jump that my primary client base are tech and biotech companies. Tech and biotech companies tend to seek that moment of monetization at what we call exit. Sometimes it's called an exit transaction. Sometimes it's called a liquidity event. It's the end of the rainbow. It's when you sell your company. And typically you do it through what's called an M&A transaction, which stands for mergers and acquisitions. Sometimes an IPO, an initial public offering, where you sell stock to the public and you become a publicly traded security that you can show your friends and family on NASDAQ or the New York Stock Exchange. But for most startups, exit comes through an M&A event. And that's when really oftentimes for the first time, the founders have the opportunity to cash a check. You know, these companies lose money along the way because they're engaged very much in research and development, product development, market development, and all the basic brute force work that takes place at the beginning to prove that this thing actually is something and can go somewhere. And then at that point in time, a big fish swims up and says, I think I'd like to buy that, slap it into my existing corporate structure and monetize it. And I'll pay you a lot of money for it. And when that happens, essentially what happens in that transaction is that all of the assets are converted into money. So what are the assets? It's the good stuff. It's basically everything that's good in the business except the people. So anything that you can think of that contributes to the business, that's an asset, okay, in a very general sense. And when you sell your company, when you monetize this business, when you make this journey, when you convert it into cash in your pocket as a founder, whether in 1 year, 3 years, 7 years, or 12 years, you're converting those assets into cash. So then what happens? Well, the next thing you need to do is you need to pay off the liabilities. What are the liabilities? Those are the bad things, okay? That's what you owe the bank. It's what you owe the landlord. It's what you owe your attorneys. It's what you owe your accountants, employees, contractors. It's the money you owe, okay? So you've taken all the good stuff that you've created over the years. You've sold that to a buyer, converted it into cash. Then you pay off your liabilities. So if we want to play around with this formula a little bit, in addition to saying assets equal liabilities plus equity, we can say assets minus liabilities equals equity. So if you're STEM in orientation, you probably knew that and could figure this out when you were 7. If you're not so STEMmy, this is more like maybe 26 or 27 years old when you can understand the math that I just engaged in. But the bottom line is you take your assets, convert it into cash, you pay off your liabilities, and then what's that mean? Whatever's left is available for equity. And why do we care? Why did I spend 3 minutes on this? Because equity is where you live, okay? That's where the owners are. That's where the founders live. So the objective in companies like this, in addition to solving a problem, in addition to creating a legacy, in addition to building value, in addition to creating an interesting culture and a fun place to spend the time and energy that it takes to build a company like this, but you know, you're also driving towards this exit event, this monetization moment. And ideally, you take your good stuff and you convert it into a whole bunch of cash, and your bad stuff is pretty low, which leaves a lot of cash available for equity. Sometimes we'll call these net proceeds. Why? Well, the cash we get for the assets, those are gross proceeds. All the proceeds, all the cash. And then we pay off the liabilities. That means what's left is net of the liabilities. So the gross proceeds, net of the liabilities, are the net proceeds, and that's what's available for the founders. That's what's available for the owners. That's what's available for the investors. That's what we're working towards. This lays the foundation for everything that we do moving forward. So the question then becomes, okay, interesting. We have a sense now as to where we're going in building this company, what we hope to achieve and how we hope to achieve it. We want to convert these assets into cash. We want to keep our liabilities low. We want to have a lot of cash left over, these net proceeds available for the owners. How do we know how to chop it up amongst the owners? If there's one owner, it's easy. They get 100% of the net proceeds. But what if there are two owners, 7 owners, 42 owners, 157 owners? Short of putting a sharp stick in everybody's hand and telling them to have at it, and the one who survives gets the proceeds. How do we solve for this? Well, the way we solve for this is by looking at the capitalization table. And this is sometimes referred to as the cap table, which is about as creative as lawyers and accountants will get. There's a reason that you will hear accountants, lawyers, investors, and others talk about the cap table incessantly. And not just talk about it, but insist upon its accuracy, its completeness, that it's up to date. And the reason for that is you do not want ambiguity around how the net proceeds get chopped up. You want it to be obvious. You want it to be precise. You want it to be clear. You want to know at all times how the net proceeds will be allocated in the event of sale, because that is the existential moment of truth in these companies. And what tells us that is the cap table, okay? Now, in its very basic form, our cap table will look like this. And let's say, for the sake of argument, that we have 3 founders. And we'll slide them here. And they were bound to work together because it's founder A, founder B, and founder C. A remarkable coincidence. Our columns have 2 headers, shares here, put a pin in that, we'll come back to it, and ownership percentage here. This is a cap table in its simplest form. And when I sit down with a founding team for the first time, this is what I sit down with. And after chatting with them about what they're doing and why they're doing it and what their story is and how they got to where they are and where they want to go, when we're starting to get to brass tacks and we're having this conversation, the first question I will say is, okay, well, we have our cap table and our percentages must add up to 100%. So founder A, what percentage of the company do you own, or do you want to own, or are you planning to own? And founder A will say, well, it's my idea. I'm the full-time CEO. I'm going to be driving this. And as we discussed, I own 80% of the company. And founder B says, well, I may not be doing this full time, but I'm the tech co-founder, and we all know how important the tech co-founder is. And as a consequence, as we discussed, I own 60% of the company. And founder C says, well, that's all really interesting. I'm in sales, and without my ability to actually market and sell this product, this is just a science fair project. So as we discussed, I own 60% of the company. Well, you can see the problem. I mean, we all try to give 200% all day, every day as good American citizens and participants in our aggressive capitalistic economy. And that might work, when talked about on a LinkedIn post, but it doesn't work so well in an Excel spreadsheet. And it kind of breaks, because the bottom line is 100% is a hard limit. And we need to force our 3 founders into that 100% bucket. They have to fit underneath that ceiling. And sometimes these are the hardest conversations that the founders will ever have over the course of the entire duration of the company. I've seen this result in some hurt feelings, lots of gnashing of teeth, sometimes tempers, sometimes tears. But at the end of the day, it's got to be resolved. And frankly, it should be resolved sooner rather than later, because like most problems, they don't get solved by waiting or by kicking the can down the road. So let's say that our founders did that, and notwithstanding the discrepancies that we identified through this initial conversation, they went back to the proverbial whiteboard, and they determined that founder A should have 60%, and founder B should have 20%, and founder C should have 20%. And we're all very happy because that math works. It adds up to 100%. And we know, based on what we said before, that based upon these percentages, that if the net proceeds available for distribution post M&A are, let's say, $10 million, founder A will get $6 million. Founder B will get $2 million. Founder C will get $2 million. Okay? The cap table lays over the balance sheet and tells us how this allocation works. Easy peasy, no sharp sticks required. So now let's visit this initial column, shares. If you have an LLC, a limited liability company, ownership interests might be called membership interests. They might be called units. They might be called shares. They might be called elephants. They will be called whatever name you have ascribed to them in the document called an operating agreement, which is the overarching governing document of an LLC. If you have a corporation, it's a little bit more simple and straightforward. They're called shares, or they're called shares of stock. But the bottom line is these are representations of ownership percentages. Okay? We like to point to things to represent what we own. Okay? 200,000 years ago, when our ancestors were roaming around in the savannah, they collected nuts and berries, and they had an immediate sense as to what they owned and what they possessed by looking down in their hands. And they knew that, 3 nuts was better than 1 nut, and 100 berries were better than 20 berries. And it gave them a tangible sense as to where they stood and the level of ownership and the level of wealth that they had. And that just carries forward to today, except instead of nuts and berries, it's shares of stock. So the question becomes, how many shares? Well, this works. 6 shares, 2 shares, 2 shares, for a total of 10 shares. Or we could say 60, 20, 20, 100. Or we could say 6,000, 2,000, 2,000, 10,000. Or we could say 6 million, 2 million, 2 million, 10 million. Does it matter? No, it doesn't matter. And that's the key element that I want you to pull away from this slide. This may be the most important piece that you take away from this entire presentation, which is that the number of shares is irrelevant on an objective standalone basis. Shares matter only insofar as they tie back to ownership percentage. They are relative in terms of their value, in terms of their importance, in terms of understanding what they mean and represent. We started here as a possibility saying 6 shares, 2 shares, 2 shares, 10 shares. If you're founder A and you go tell your friends that you own 6 shares of stock in your startup, they might look at you like you're a sucker, because 6 shares doesn't sound like very much. You might say, well, I own 6 shares of GE, and that's not worth very much. So why would you be pouring your life into this entity where you only own 6 shares of stock? Well, I can promise you that 6 shares of General Electric does not represent 60% of the total ownership of General Electric. Whereas in the startup, 6 shares of the startup represents 60% of the total ownership of the startup. That's what matters. This is the numerator, the 6 shares. This is the denominator, the total shares. It gives us a percentage. That's what we're directing toward. That's what we're looking to. That's what we're trying to identify and define. That's what matters. We can, of course, get there through millions if we want. And in the world in which I swim, in the tech and biotech world, this is what we usually do. We like to use big numbers. And part of the reason for that is because it looks like lots of nuts and berries. People feel paper rich. People feel paper wealthy. They tell their friends that they own 6 million shares of stock in their startup. They're not a sucker anymore now. They're a baller, okay? Is there any difference objectively? No, not at all. But from a optics perspective, it feels a little better. And that, if nothing else, is the reason for the big numbers. It's psychological. But keep that in mind. Shares are valuable, are relevant only insofar as they tie to ownership percentages. So note that thus far, we've been using this generic term shares. Many of you, perhaps all of you, probably have heard shares referred to as common shares, and have heard some shares referred to as preferred shares. So the question becomes, what are these things? More importantly, what is the difference? Common shares are the default shares. If something is just called a unit or just called a share, by default, it's a common share. Common shares, 99% of the time, are awarded to people who are getting their shares in exchange for services. So if you are getting shares in your capacity as a contractor, a consultant, an employee, a director, an advisor, an executive, a founder, you're getting your shares for services, you are going to be getting common shares. As with almost anything, there are exceptions to the rule, but they are rare. And even more rarely are they justified or warranted. There is much to be said for staying within the norms and staying within market guidelines. It works best for founders, frankly, because what's good for the goose is good for the gander, and this shows up in other places. It also works well in terms of attracting capital from investors and then later on selling your company. Most people do not like to see deviations from the norm unless there is a strong rationalization for that, and there frequently isn't. So common shares are awarded, they're issued to people in exchange for services. So what does that mean with preferred shares? Well, preferred shares go to people who are getting their shares for money. Investors get preferred shares. And not only because they prefer it. I mean, certainly it's a better name. So, hey, if you're paying money for your shares, why wouldn't you ask for preferred shares rather than boring old common shares? And you'll talk to some investors, and that's exactly their rationale. They have no idea what they're asking for or why. It just seems that they should prefer it because they're called preferred. So, hey, why not? I'm writing the check. But let's tear this apart a little bit. We could spend half a day talking about preferred shares. We could spend 2 days talking about preferred shares. But how about we spend 5 minutes? At a very high level, here's what I want you to take away, and it's very important that you never lose sight of this. Common shares and preferred shares on a fundamental economic basis relate to each other one-to-one, okay? On our cap table, we don't need to differentiate in this simplistic approach between common shares and preferred shares. 6 million shares is 6 million shares, 2 million shares is 2 million shares, 2 million shares is 2 million shares. If we add an angel investor and give them 1 million shares, that can show up in this column too, okay? As economic units of value, as ownership interests, 1 is to 1 is to 1 is to 1 is to 1. Never lose sight of that. There are exceptional edge cases where this can deviate. That's way outside the parameters of this presentation today. But 99.99999% of the time, 1 share of common stock relates to 1 share of preferred stock. So the reason that I hit this nail hard is because it's very easy to become lost in what I'm about to talk about in terms of what some of the advantages or distinctions of preferred shares are. But what I would say is 95% of the whole battle is tied up in this fundamental point. And that's a good thing from the perspective of the founders. Okay. So if it's 1-to-1, obviously there must be something which sets preferred shares apart. Otherwise, there'd be no reason to have preferred shares. And it shows up in 2 places, 2 big categories. One is control, and the other is economics. So let's hit control first very quickly. 2 places here. First and foremost, preferred shares usually themselves will have the right to appoint 1 person to the board of directors. And this matters because in a corporation in particular, you have stockholders who are the owners, and they don't have the opportunity to weigh in on much. They vote on the sale of the company. They vote on amending the basic charter documents. But what they also vote on is they vote on the board of directors. And this is where the action is. The board is where the buck stops. The board is responsible for the affairs of the company, okay? They have a fiduciary duty to act on behalf of the stockholders. And in this capacity, the board weighs in on lots of issues. One of the issues they weigh in on are the officers, the people that actually run it. The officers report to the board. And guess what? This is where the founders live, okay? Being a founder is a beautiful thing, but it's an existential thing. It's a psychological thing. It's a quasi-fictional thing. Being a founder doesn't give you specific rights, responsibilities, duties, protections, obligations, anything. It is not a legal concept at all, being a founder. That's why when you are a founder or you speak to founders and you see their business cards or you looked at their signature blocks, it is rare to see someone just reference themselves as a founder. And I would argue not a good idea to just reference yourself as a founder because it gives no expression as to what you do. You have the founder and chief executive officer. You have the founder and chief marketing officer. You have the founder and chief financial officer. You have the founder and chief technology officer, okay? The founder piece is the hype piece. But what really matters from a legal perspective is what follows that, the role you have. And especially in the early days, it's likely that as a founder, it's going to be a C-level position. And in that capacity, you report to the board, which means they have the right to not only oversee you, they have the right to fire you. Okay, this is what terrifies founders. I don't want to quote unquote lose control of my company. I don't want to quote unquote be fired. So founders are intensely focused on the composition of the board of directors. And investors and the holders of preferred stock know this. Generally speaking, they're not going to look for majority control. So you might have a board of 3 people, and you'd have 2 founders, and then you'd have 1 preferred stockholder. Or maybe you have a board with 3 founders and 2 preferred stockholders, okay? They want to be in the room. They want to know what you're talking about, all these other business and affairs relating to the corporation. They want to know what's being said about the performance of the officers and the other employees and executives. They want to be in the mix. They want the opportunity to influence the strategies and the tactics that are being taken by the team. But they're okay with being in the minority. They're okay with not exerting majority control, but they want to be there. And generally speaking, as preferred stockholders, they're going to get the right to designate one of those directors. Founders, don't freak out about that. Just keep an eye on the count, okay? That's the key piece. What else about control? Well, I mentioned on this slide that stockholders weigh in on very few items. Sale of the company, amending the charter documents, electing the board of directors. That's pretty much it. But you can certainly negotiate anything by contract, and that's what preferred stockholders do. And they say, not only do we want a board seat, but we want to have, as investors, certain veto rights. And the list of activities and actions over which they can exercise a veto is generally pretty limited. The generic template boilerplate style is typically 5 to 6 items, which are incredibly organic in nature: sale of the company, dissolution of the company, distributing cash to the stockholders, raising more money, those sorts of things, which go to the value of their investment, okay? They're not going to say things like the square footage of the company headquarters, okay? They're not getting into those sorts of niceties. Very high level stuff, but stuff that go to the root of what they're investing in and why they're investing and what they hope to achieve. Note, though, that it's a veto right, okay? These aren't affirmative rights. They don't have the right to force the sale of the company within these provisions. They don't have the right to force the company to raise money. They can just block it, okay? And what I would tell you in practice is the actual literal veto is rarely exercised. It'd be extremely unusual, to the point of being almost negligible in probability, that you would ever have a case where the board approved an action and it went to the preferred stockholders and the preferred stockholders vetoed it. Instead, what happens is the board, the founders, are cognizant of these veto rights, so they know they need to engage the preferred stockholders in these discussions. Hey, we want to raise more money. We want to make sure you support it. Here's how we're thinking about doing it. Are you cool with that? Anything you want to say? Anything you want to add? And that's what preferred stockholders are really looking for. They're not looking to veto corporate actions. That creates friction. That creates animosity, throws people into disalignment. They just want to be heard. And this is a way to require that they be heard. It incentivizes the board and the founders to come to them. So these are the 2 big control issues that you typically find with preferred securities. What about the economics? Well, I said the big one, 1-to-1, but there's another element of the economics. And that gets into a couple of buzzwords here. we have liquidation preference, and then we have participating versus non-participating. And again, this could be a whole day. We're going to fly through it. So what are we talking about here? Liquidation preference is typically a multiple of what they paid. And 99% of the time, it's 1x. Okay? So if an investor invested $1 million in the company, the liquidation preference is 1x the purchase price, or $1 million. Okay? The question then becomes, what happens with this liquidation preference? And that goes to whether the preferred stock is participating or non-participating. Now note that I don't just call this a preference, I call it a liquidation preference. Most of you have an intuitive sense as to what liquidation is. Just like you have an intuitive sense that assets are good and liabilities are bad, you think of liquidation as bad. You've seen people holding placards outside of carpet shops, going out of business, everything must go, 90% off, yada, yada, yada. That's certainly a liquidation, and that applies here. Those are bad liquidations. But there are good liquidations. When you sell the company and you turn your assets into a whole bunch of cash and you pay off your liabilities, and then you've got this money, these net proceeds to spare that are available for distribution to the owners as equity, how do you get it to the owners? Well, you liquidate the company in order to distribute the cash to the owners. That's a liquidation. And if you sell your company for $1 billion, it's a good liquidation, okay? So what we're talking about here is what is happening in the context of not only a going out of business circumstance, but what's happening in the context of an M&A event. And as we said at the top, an M&A event is the endpoint that we're all striving to get to. So it's important in scenarios both good and bad. The way we can tell the difference between participating preferred versus non-participating preferred is looking at conjunctions. I bet you didn't see that coming. Participating, we're going to look for and. Non-participating, we're going to look for or. Let's start with non-participating first. In the event of the liquidation of the company, our preferred stockholder is going to get the greater of their money back, their liquidation preference, or what their ownership percentage would get them of the net proceeds. So they would look back to the cap table, right? And let's say they own 10% of the company. In this scenario here, they would say, what brings me more money? Just getting my $1 million back, or 10% of the net proceeds as a basic stockholder? If it's a bad liquidation, probably just getting their money back, or at least some percentage of it, is best for them. And that's what they'll opt for. If it's a great liquidation, they just sold to Facebook for $500 million, they're going to take 10% of that for sure. Okay? So it's or. And sometimes this is referred to as downside protection, because it really only comes into play in a bad liquidation scenario. In a good liquidation scenario, the preferred stockholder looks just like a common stockholder. They get their percentage on the cap table. That transcendent 1-to-1 ratio holds. Well, then what does that mean about participating preferred? Well, participating preferred never has a decision to make. They get both. They get their money back and they get their ownership percentage. So really our equation kind of looks like this. Our assets turn to cash, then we pay off the liabilities, then we pay off the liquidation preferences that the preferred stockholders have, and then whatever's left, our net proceeds, go to the owners. And by the way, that includes our preferred stockholders too. They get to go twice. That's why sometimes people refer to this as double dipping. As you might imagine, the people that call this double dipping don't like it very much. There are some people that have very strong feelings about participating preferred, both positive and negative. What I would suggest is that this is not the kind of thing to have strong feelings about. Rather, it's the kind of thing to simply understand, okay? It goes to the economics of the deal. So understand how it works, understand the impact, decide if you're okay with it. Maybe you are, or maybe you aren't, but act accordingly, but don't treat it as an emotional issue. And don't treat it as one of fairness or something coming out of principle. It really, in some respects, we're going to talk about this in 2 seconds, goes to valuation. Valuation, interesting. Let's talk about valuation. Whenever you sell stock, And this is where we are in the life of this company. So the founders have done some interesting stuff, and it's time for them to go out and raise some money. There are two interrelated equations that you need to understand and pay attention to. And I'm going to write them on the whiteboard, and then we will unpack them piece by piece. You have pre-money valuation divided by pre-money equity equals price per share. Let's call that PPS. And then you have investment amount divided by PPS equals number of shares. So here's the thing. Our founders and our angel investor, yay, angel investor, thank you, Wings, Halo, you rock, have agreed that this person is going to invest $500,000 into the company, and everybody's ecstatic, okay? But we have to figure out how many shares this investor gets for this $500,000, because we need our cap table to be up to date. We need our cap table to be accurate. So as a consequence, we need to work through this math. We need to get to the number of shares. Are they getting 10 shares? Are they getting 100 shares? Are they getting a million shares? Well, we need to figure that out, because without knowing how many shares they're getting, we can't input them into the cap table. And if we can't input them into the cap table, then our cap table is incomplete, which means we're going to be dealing with sharp sticks and violence and blood when it comes to the allocation of net proceeds at the end of the rainbow. Let's avoid that. So how do we determine the number of shares? Well, the numerator is investment amount. We know that, $500,000. This is what they're investing. Okay, so are we there? Well, the denominator is price per share. Do we know what the price per share is? We don't. Dime, nickel, a dollar, we don't know. But we know how to figure it out. This equation. Let's start with the denominator. Pre means before. I think you're tracking. Money means money. How about that for a plot twist? Before the money, in other words, before this $500,000, what was the total equity? Well, we look at our cap table, okay? And we don't have this investor on yet. At this point in time, we had 6 million shares, 2 million shares, 2 million shares, a total of 10 million shares. 10 million shares is our pre-money equity, okay? Awesome. We know our denominator. Almost home. What's our numerator? Pre-money valuation. Pre means before. Money means money, specifically this investment amount. Before that investment amount is made, before that investment is made, what is the value of the company? Is it $1 million, $5 million, $10 million? The math flows from there. If it's $5 million, we know that our price per share is 50 cents. 5 million divided by 10 million. And if our price per share is 50 cents and our investment amount is $500,000, we know that the total number of shares is 1 million. Okay? If it's a 10 million pre, well, it changes things. Our price per share is not 50 cents. Our price per share is $1. If our price per share is $1, then they're not getting 1 million shares. They are getting 500,000 shares. So something you're realizing very quickly. Our founders want a very high price per share, because the higher the price per share, the lower the number of shares, which means the lower the ownership that the investor gets. How do you get a high price per share? High valuation. And of course, our investors are just the opposite, right? They want a low price per share. The lower the price per share, the more shares they get. The more shares they get, the more the company they own. How do they get a low price per share? A lower valuation. That's our debate. Valuation. Founders want it high, investors want it low. It's not just about ego and marketing. It actually has a real world impact. Okay? What percentage of the company is the investor ultimately going to get? What percentage of the company is the founder giving up in exchange for that $500,000? And the whole point is, if you are selling stock, you have got to achieve agreement on valuation. You cannot run this math without valuation. no negotiated valuation, no deal. You literally cannot consummate the transaction. Now, there was a point in time where that happened a lot. And that point in time happened when I started my career in 1996, the beginning of something called the dot-com bubble. And the dot-com bubble, way back in these prehistoric times, it was when the internet was born. And of course, you know, like good consumers, we take something that's academic and somewhat pristine, and we decide, wouldn't it be great if we could sell dog food over this? And we invented e-commerce. And it was a very interesting time because suddenly businesses had the opportunity to reach 6 billion potential consumers in one fell swoop, rather than just the people that lived in their neighborhood. And there was a sense that these sorts of companies and these sorts of opportunities were worth something at incredible proportions, but nobody knew what, because there was literally no precedent for this. You couldn't look to anything. There were no comps. This was all brand new. So when the founders, on the one hand, and the angel investors, on the other hand, are trying to negotiate valuation, the founders are saying, our companies are worth a lot because this e-commerce stuff, this internet stuff is incredible. And the angels were saying, we get it that it's worth a lot, but we don't think it's worth that. We think that's pretty speculative and quite a reach. We think it's more like this. Well, they were at loggerheads because, you know, look, if the founders think the company is worth $5 million and the investor thinks the company is worth $4 million, you're probably going to meet somewhere in the middle and you're going to get that deal done. But if the founders think the company is worth $100 million and the investor thinks it's worth $2 million, that's just a bridge too far. It's a gap too wide. You can't cross that. And they kept bouncing into this. They kept running into that wall, and they were unable to close transactions, which was incredibly frustrating for everybody. The founders needed the money to grow. They wanted to sell freaking dog food, man. The angels wanted to get into the mix too. I mean, they wanted to put the $500,000 to work. They wanted to make a lot of money, but they couldn't get a deal done. So what was invented to solve this was the promissory note. Now, here's what's interesting. It wasn't really invented. We've always had promissory notes. What happened is a lawyer said, you know, we've been fixated on this equity quadrant of the balance sheet and struggling with the fact that we can't agree on valuation. But there's another quadrant on the right-hand side of the balance sheet, and that's liabilities. Why don't we play with that? So instead of selling stock, because we're stuck, let's just do debt, okay? Let's create a liability. Let's create an obligation. And we will memorialize that in something called a promissory note. And the great thing about promissory notes is they are so simple. You have principal, which is the amount invested or the amount loaned or advanced. And in our example, it's $500,000. You have to have an interest rate because the IRS doesn't believe that people lend money for free. It could be 5%, it could be 20%. The market settled at 8%. It's not tied to prime. It's not tied to what the Fed is doing. It's not what's happening with the macro global economy. Somebody just plugged that in 1997 and it's stuck. Maturity date, when does this thing come due? You also have to have this with a debt instrument. There has to come a point in time where principal and interest are repaid. These are not like car notes or like mortgages where the company is making monthly payments of principal and interest. Instead, it all just comes due at the end. The founders want as much time as possible to repay these. The investors tend to like it on a shorter fuse, but the market has sort of settled out at 18 to 24 months. That's when it becomes due. Okay? So we did that. This was version 1.0, and it worked for 5 minutes, and then everybody was really, really upset. Why were they upset? Well, the founders were upset because they were like, look, we've got to repay this, and we're not going to have the money to repay this. This is not that kind of company. Okay, we're never going to be flush with cash. To the extent that we even generate cash, which we probably won't, we're going to be investing it back in our business. We can't be we just don't have the free cash flow to repay these notes. So you have solved one problem, but you've created another one for us. Okay, so the founders were terrified. So maybe you think, well, that means the investors were happy. No, the investors were irritated too, because these angels were saying, look, I'm not investing this money into this really cool dog food e-commerce company because I want 8% back on my money per year. That's not an interesting return for me for something so risky. I want to be 10% of the company, 20% of the company, 5% of the company, whatever it is, but I want a piece of the net proceeds. I think this is $1 billion opportunity and I want a piece of it. And so they were upset because they weren't seeing that. So what happened is lawyers went back to the chalkboard or the whiteboard and they said, tell you what, here's something we can do. Why don't we make these convertible? What we'll say is, yes, we start with principal, interest, and maturity date. But at some point in time between the issuance of the note, it's when the investment is made, and the maturity date, when it needs to be repaid, it's somewhere along the way, there's going to be an investment transaction where real money is going to come into the company, venture capital or otherwise, and it's going to buy stock, and it's going to ascribe a valuation to the company. And let's just piggyback on that and convert the note from debt to equity. How's that work? Well, remember our equations. Pre-money valuation divided by pre-money equity equals price per share, and then investment amount divided by price per share equals number of shares. So our VC shows up. Let's say they show up at month 12. And you know it's a VC. They don't have angels and wings. They definitely don't have angels. They definitely don't have wings and halos. I promise you that. But what they do have is they have Patagonia vests and they have Allbirds. So look for that. That's how they can be identified in the wild. So the VC shows up and the VC says, I'm really smart. I read Sapiens. I know how the world works. I'm educated. I'm cultured. I know how to value companies. I want to invest $5 million into your company, into your dog food e-commerce company. And I think your valuation is $10 million. And the founders say, you know what? That sounds good to us. So here goes our math. We have a pre-money valuation of $10 million. Thank you, VC. Founders say, thank you, VC. Pre-money equity, it's still 10 million shares. Our original cap table still holds, notwithstanding the fact that we have this note hanging out there. We'll get to that in a moment. So $10 million pre-money valuation divided by 10 million shares, we have a price per share of $1. Our investment amount, $5 million. $5 million divided by $1, 5 million shares. Our VC gets 5 million shares. Boom. We can insert that in the cap table. Everybody's happy. Well, what about our note? Well, our note is just going to leverage what took place here. Same pre-money valuation, same share number, same price per share. That price per share gets inputted here in the denominator, but the numerator, instead of being the $5 million that the VC puts in, it's the principal and interest of the note. It's going to be the principal amount, $500,000, probably the interest too. Sometimes interest is repaid in cash, but usually not. Typically it converts. So let's say it's $510,000. Okay, $500,000 in principal and $10,000 in accrued interest. Okay, sorry, 510. $510,000 divided by $1, 510,000 shares. Okay, what's our cap table look like? Our founder A, 6 million shares. B, 2 million shares. C, 2 million shares. Note, they still have the same number of shares. That doesn't change. Their shares aren't reduced. Founder A got 6 million shares on day one. They still have 6 million shares on day 400. What's different? Well, our VC has 5 million shares. Our angel has 510,000 shares. Okay? Now our math is going to get a little wonky, but we don't have 10 million shares anymore. Instead, it looks like we have 15,510,000 shares. Now, I was a history major. I was not a math major. So in real time, I cannot tell you what 6 million divided by 15,510,000 is. But you know what I can tell you? I can tell you it's less than 60%. That's called dilution. Our founder A, and this goes for founder B, their 20% drops. Okay? They still have the same number of shares. They just have a lower ownership percentage of the company because remember, 100% is a hard ceiling. Okay? You don't get to bust through that. So instead of owning 6 million divided by 10 million, They own 6 million divided by 15,510,000. Okay. They've given up a chunk of the company, but hopefully in exchange, they've gotten cash that will help them drive the value to a level at which they can be pretty excited about their potential outcome. This is how it stacks up, and this is how it works. Now, we don't have a lot of time left, so let's hammer through a couple of further key concepts. In notes today, you will find that they frequently have both a discount and a cap. A discount, simply put, is a percentage off of the price per share paid by the VC, and the discount is usually 20%. So if our VC ends up with a price per share of $1, our angel investor is going to have a price per share of 80 cents. That's good for the angel investor. You know, the price per share is a little bit lower, and as a consequence, they're going to get a few more shares. For a while, a discount was the only available juice in these notes. So this would be like version 3.0 of the notes. Version 4.0, which was around 2010, 2011, introduced the cap. And the cap was a notion of saying, look, it's all well and good that, you know, Allbirds shows up and describes his pre-money valuation of $10 million, but that seems really high. And a lot of good stuff has happened since the time that we invested. And in fact, our money, our $500,000 probably paid for a lot of that good stuff. And we're not getting any value for it. And this discount's cute, but it's not enough. So what we are going to do as the angel investor is we're going to say that we're going to put a hard cap of $5 million. In no event will the pre-money valuation be higher than $5 million. They're force limiting the price per share. They're ensuring that they get a lot more bang for their buck than the VC does. That's the bet that the angel investor is making. And that's the function of a cap in this context, is to put a ceiling on it so that if we have a chart that looks like this, and if this is time, and if this is value, and if the value of the company is going up like this, and the VC shows up here, and our angel investor showed up here, our angel is saying, look, we don't want to invest at this valuation, even with a discount. We want to draw a hard line here. We want to ensure that we will never convert at a value above that, because we want to maximize the number of shares we get. Now, something that you may see here that may be confusing is you might say, well, it sounds like a cap is a value. Sounds like cap is valuation. Sounds like cap is pre-money valuation. How was that happening? I thought the whole reason we did a note was because we couldn't agree on pre-money valuation, and you would be right. But what happened was the rationalization for notes changed over time. In 1996, we needed notes because there were no precedents, and we couldn't agree on valuation. In 2011, 2010, we used notes simply because they're convenient. So we had lots of precedents by then. We had 15 years of deal activity. We knew how to value e-commerce companies and other companies. We had a pretty good sense as to what the range should be. That's why we can calculate a cap, okay? Well, then why use notes? Why not just sell preferred stock? Well, it's because they're convenient. They're so simple. They're short. Principal, interest rate, maturity date, discount, cap. That's it. That is it. And because it's so simple and so elegant, it's incredibly attractive to investors. We have 4 minutes. We're going to talk about safes. These were invented in 2013 by Y Combinator, an accelerator in the Bay Area. It's an acronym. It stands for Simple Agreement for Future Equity. With a safe, what Y Combinator said is we love notes. Notes are fantastic. They're so easy to do, but we hate maturity dates because maturity dates put a lot of pressure on companies to get Mr. or Mrs. Allbirds to show up in time. We don't want a maturity date. Let's just let these companies grow and let them blossom in accordance with the pace and cadence that's natural and organic and required. And by the way, we also hate interest rates. They're kind of goofy from a tax perspective. They make our equations weird when we do these conversions. It's not 500,000 shares. It's 512, 833 shares. It can have some odd tax consequences. Let's just eliminate it. Okay. Principal And then we'll give you some optionality here around discounts. You can have discounts or not. You can have caps or not. And if you go to the Y Combinator website and you search under safes, you'll find that these are downloadable right from the website, and you can choose. Do you want a discount and or a cap? You pick, and they'll get and the proper form spits right out. Now the question becomes, what's a safe then? Because if there's no interest and if there's no maturity date, it's not a liability. It's not debt. It can't be. Okay? So that means it cannot exist in the liability quadrant, which gives us only one choice because there are only two quadrants. It exists in the equity quadrant. But wait a minute. I thought only stock existed there. Well, this sort of is stock. It's a right to acquire stock. And a right to acquire stock shows up in other places in your company. That's what a stock option is. Sort of thing that you will issue to employees and directors and advisors and contractors and consultants over time. A stock option is merely a right to acquire stock. It lives in the equity quadrant of the balance sheet, and that's what a safe is. A safe is a type of stock option. It's even better than your typical stock option, because usually with a stock option, what happens is the option is issued. Handwriting is atrocious. Thank you for your patience. The option is issued, time goes on, and then the investor says, hey, I'd like to exercise that option. So here's my money. And the company says, great, here are your shares. Okay? What's different about a safe? The money's paid up front. And then you simply wait for the trigger event, which is Allbirds showing up. And that's when the shares are issued. So to be even more precise, a safe is not merely a stock option. A safe is a prepaid stock option. And these have become increasingly common. So if you are a founder and you're raising money, you're going to be raising money through one of three means. You are going to be selling preferred shares or preferred stock. You are going to be selling convertible promissory notes, or you are going to be selling safes. And this is where they come from, and this is how they tie together. We are at 1 o'clock, right on time. I realize that we covered a ton of substance. I appreciate the patience. Whoa.
Sorry, I'm trying to navigate with a crying baby over here too.
That's okay.
I
I thought maybe that was the audience, because sometimes that's
it
how I
is
feel
not.
when
I just want to say thank you for sharing with us today. And audience members can hop over to our 1 o'clock session right now. Thank you, Dave.